Central bank digital currencies, CBDCs, are a revolutionary financial concept where central banks issue digital versions of their national currencies. Unlike cryptocurrencies like Bitcoin, CBDCs are centralized, backed by the state, and subject to regulation by the issuing central bank. As CBDCs gain traction globally, their potential impact on traditional banking systems and the broader economy has become a major point of discussion. Here's a look at how CBDCs affect banking and what the future might hold. Payment systems and CBDCs. One of the potential benefits of CBDCs is the improvement of payment systems. Today's payment systems, both domestic and international, are often slow, costly, and dependent on intermediaries like banks or payment processors. CBDCs, being digital and potentially blockchain-based, could enable faster, more efficient payments with lower transaction costs. This is especially significant for cross-border payments, which often involve high fees and delays. If central banks can create efficient and widely accepted digital currencies, the need for commercial banks as intermediaries in payments could diminish. This would reduce banks' control over payment processing, forcing them to adapt to a new competitive landscape. Monetary policy and financial stability. CBDCs offer central banks new tools to implement monetary policy. With digital currencies, central banks could directly influence the money supply more efficiently. For example, in times of economic downturn, they could issue CBDCs directly to citizens' digital wallets to stimulate spending, bypassing traditional banking infrastructure. However, this also presents challenges for financial stability. If a CBDC becomes too attractive compared to traditional bank accounts, it could lead to bank runs, where customers quickly transfer their funds from commercial banks to CBDCs, destabilizing banks. Therefore, central banks would need to carefully manage the rollout of CBDCs, ensuring that the banking system remains resilient. Impact on commercial banks' profitability. Banks derive much of their revenue from lending activities. With fewer deposits, banks may need to turn to alternative sources of funding, potentially increasing their cost of capital. Additionally, if CBDCs become a widely used form of payment, commercial banks could lose revenue from payment processing and transaction fees, as CBDCs could bypass their services. Moreover, banks charge interest on loans, but the issuance of CBDCs might allow central banks to directly manage credit and lending in certain situations. For instance, in times of economic stress, central banks could issue low-interest CBDC loans to stimulate the economy, potentially competing with traditional banks in the credit market. Banks' role in the CBDC ecosystem. Despite the challenges, commercial banks are likely to remain integral to the financial system, even in a world with CBDCs. Rather than being sidelined, banks might take on new roles in the CBDC ecosystem. For instance, they could act as custodians of digital wallets, offering secure storage and additional services to customers. Banks could also provide financial intermediation services that leverage CBDCs, such as offering loans in CBDCs or facilitating cross-border transactions. Furthermore, while central banks may issue CBDCs, they may not want to handle all aspects of managing millions of individual accounts. Commercial banks and fintech companies could still play a critical role in customer service, compliance, and innovation around digital currency products. Financial inclusion. CBDCs have the potential to promote greater financial inclusion, especially in regions where people lack access to traditional banking services. Since CBDCs could be accessed via mobile devices, individuals in underserved areas could use digital currency without needing a bank account. This could allow central banks to provide a more inclusive financial ecosystem. However, this could also reduce the dependence on traditional banks, as people without bank accounts would have direct access to a national currency. Banks may need to innovate to provide added value and stay relevant, especially in emerging markets. Regulatory and compliance considerations. The introduction of CBDCs would also necessitate a rethinking of regulatory frameworks. Currently, banks play a critical role in enforcing anti-money laundering, AML, and Know Your Customer, KYC, regulations. With the introduction of CBDCs, central banks would need to implement strong regulatory measures to ensure these digital currencies are not used for illicit purposes. CBDCs could also increase transparency in financial transactions, as central banks could have greater oversight over digital currency flows. This could enhance regulatory compliance, but it would also introduce concerns about privacy, as citizens may be uncomfortable with the level of data available to central authorities. Adapting to technological change. The adoption of CBDCs would drive technological change in the banking sector. Banks would need to upgrade their infrastructure to handle digital currencies, integrating them with their existing systems for customer accounts, payments, and lending. This could require significant investments in blockchain technology, cybersecurity, and digital services. Moreover, banks would face increased competition from fintech companies that are better positioned to innovate in the digital currency space. Fintech firms may offer more agile and customer-friendly CBDC services, prompting traditional banks to adapt quickly or risk losing market share. The future of banking in a CBDC world. The introduction of CBDCs is likely to accelerate the digital transformation of the banking industry. While there are risks, such as the potential for disintermediation and reduced profitability, there are also opportunities. Banks that embrace technological innovation, offer new digital services, and find ways to integrate CBDCs into their operations may thrive in the new financial ecosystem. In a world where CBDCs coexist with traditional banking, collaboration between central banks, commercial banks, and fintechs will be essential. By working together, these institutions can create a more efficient, inclusive, and secure financial system that benefits consumers and businesses alike. CBDC adoption around the world. Several countries are actively exploring or have already launched CBDCs, and their experiences offer insights into how digital currencies might reshape banking. China. China is one of the pioneers with its digital yuan, ECNY. The People's Bank of China, PBOC, has launched pilot programs in major cities like Shenzhen and Beijing. As of 2023, millions of people have participated in trials, using ECNY for retail purchases, transfers, and public services. The digital yuan aims to streamline domestic payments and reduce dependence on foreign payment systems, like Visa or MasterCard, which are dominated by Western entities. Europe. The European Central Bank, ECB, is also working on the digital euro. This project is still in the research phase, but the ECB envisions a secure and low-cost digital currency that ensures European sovereignty over payment systems. The ECB has made it clear that the digital euro would not replace cash, but would complement it, maintaining a dual system of physical and digital currency. Bahamas. The sand dollar, launched by the Central Bank of the Bahamas, is one of the world's first fully deployed CBDCs. It's aimed at increasing financial inclusion in the archipelago, where access to traditional banking services is limited. Nigeria. Nigeria's Naira was launched in 2021, targeting financial inclusion and improving the efficiency of monetary transactions. It's particularly aimed at providing digital financial services to the unbanked population, a key driver for CBDC development in many developing nations. In these countries, the adoption of CBDCs is already influencing the banking sector by altering the flow of money through the financial system, providing citizens and businesses with alternative ways to store and transfer funds. How CBDCs will reshape the payments ecosystem. The payments ecosystem will see profound changes with CBDCs, especially when considering the different layers of the financial system. Instant settlements. One of the biggest advantages of CBDCs is the potential for instantaneous settlement of transactions. In today's banking systems, payments, especially cross-border ones, can take several days to clear, as they rely on multiple intermediaries, banks, clearinghouses, and payment processors. With CBDCs, settlement can be achieved directly on a distributed ledger or centralized system controlled by the central bank, reducing settlement risk and speeding up transaction times. CBDCs represent both a challenge and an opportunity for the banking industry. While they could disrupt traditional banking models by reducing the need for intermediaries and altering the way monetary policy is conducted, they also open the door for new financial innovations and more efficient payment systems. The key for banks will be to adapt to this new reality, leveraging technology and finding their place in the evolving financial ecosystem. In doing so, they can continue to play a vital role, even in a world where central bank digital currencies become the norm.